Silver's up almost $1 today, and gold at one time this morning was down almost $35. So again, I could see it. I don't like to make those type of predictions, but it would not shock me at all if you saw a rip your face off rally, which is what happens when you get people on the short side and you get buyers coming in chasing it up because they'll pay any price to get it. And I would not be shocked. Again, the stretch I made was 50. Could it get to triple digits? It will be triple digits at some point. Remember, at one time, a quarter of an ounce silver was worth 25 cents, 1964. The silver quarter is worth a quarter. Okay. And look at what it is now. I mean, again, you're 100% right. There's a hell of a chance for a pretty big move in silver. And I think there's a big move in coming in platinum as well, if you've watched the action recently.
Gold gets all the glory, but silver prices have surged nearly as much this year, up 27% to the highest levels in more than a decade. As with gold, jittery investors are scooping up the precious metal, but silver prices are getting an extra jolt from strong industrial demand, especially from solar panel makers. Todd Bubba Horowitz says silver shows substantial upside. With the gold-silver ratio narrowing from 105 to 1, silver is gaining momentum. It could reach the $40s soon, with $50 possible this year, mainly if a short squeeze occurs. Triple-digit silver is seen as likely in the long run. What should be immediately apparent is that silver is currently well above its 6-month all-time closing high of $34.65. For silver to get going, it also needs to break out from its all-time resistance line, currently around $38. Indeed, there is little doubt that the breakout from the 15-year bull pennant in 2023 was a massive milestone for silver. And if there is enough fuel in the tank to take it to the $40 area by year's end, we may be talking about the Great Silver Breakout of 2025 for generations to come. Long-term, Horowitz remains confident in gold, especially as a hedge against inflation, and plans to hold physical gold regardless of price fluctuations, expecting it to double in value over the next decade. Gold headed for its first weekly drop in 3, as a slight easing of geopolitical tensions in the Middle East sapped haven demand, and a Federal Reserve inflation warning raised the prospect of fewer rate cuts. Bullion fell 0.5% to trade near $3,353 an ounce on Friday and is down more than 2% for the week. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
If you're an investor and you're going to buy it and you're going to buy it with money that you can afford to have some variation, because I would suspect, and I know Citibank came out this morning and said they think that the top of gold is in for a while. They're expecting a 25% haircut. Now, we all know that when some big bank makes a big announcement like that, usually that means they're trying to get to the other side. They want to be a buyer, so they're trying to bring the price down. But we are pretty much overbought in here. And again, listen, I'm a big fan of gold. You know that. And I've talked to you. When last time we talked, I think I said we're going to hit 3,500, which we have. I think that gold's going to go higher, but I do believe there's going to be some pullback here. There's going to be some profit taking. There's going to be some selling. But remember, gold is also an inflation hedge or protection, which of course we still have monster inflation. So gold right now trading at 34.03 or whatever it is in the August futures. I think they pull back and create a bigger buying opportunity. But like I said, I'm an investor in the physical metals that I own. I would never sell. I don't care where gold goes, because I know 10 years from now, gold will be probably double what it is now, if not more. Okay. But between now and then, you cannot put money into a market that you are borrowing or taking away from your house or car payment to use as an investment. You have to continue to invest knowing where we can be. So I think silver is getting ready to make a huge explosion. For the last couple of weeks, we were out 105 to 1 in the ratio. And all of a sudden now we're coming back in. So I think that silver is getting ready to make a much bigger move than gold. I think it's getting ready to cut into the ratio. But I do think either one or both, and platinum, I think platinum is still a great buy down here as well. Because if you remember, at one time, platinum was twice gold. Now it's a third of. So that would be a new high. I think there's a chance. Okay, I think there's a real legitimate chance that in the 40s for sure. 50 would take a pretty solid short squeeze to get it up there, but I think it can happen. Again, I'm long silver. I own silver. I'm looking to buy more. I think it's going higher. Can it hit $50 this year? Yes. Would I outright predict it and say everybody buy it right now? Well, I'd have them buy it right now, but I wouldn't buy it just because it's based on 50. I think it sees the 40s, if not the mid 40s. And again, there's an outside shot that 50 plays because certainly, again, as I've talked about that gold silver ratio, we've got to see some of that come in as well. So I do think that there's a chance for 50, but I would certainly say right now it's trading at 36?
Somewhere in there, in that ballpark. I just had it
right
up.
now exactly. It's trading at, in the futures market, 37.31. 42.43 would be no shock. 50 would be a stretch, but I think, yes, it can get, I'll put my neck on the line. Yeah, I think you can see 50 before the year's over. It's a pretty big market. And you are fighting against a lot of the banks that continue to try to keep pressure on it. But at the end of the day, could it happen? Yeah. Listen, we've watched it happen before. You watched it happen in 08, okay, when silver went ballistic. And certainly, listen, it's a cheaper asset. It's another form. And if we realize what the true ratio was supposed to be when it was designed, the dollar system, the ratio was supposed to be 15 to 1. Well, right now we're at 90 something to 1. So certainly I could see that. I mean, right now silver is up almost $1 today, and gold at one time this morning was down almost $35. So again, I could see it. I don't like to make those type of predictions, but it would not shock me at all if you saw a rip your face off rally, which is what happens when you get people on the short side and you get buyers coming in chasing it up because they'll pay any price to get it. And I would not be shocked. Again, the stretch I made was 50. Could it get to triple digits? It will be triple digits at some point. Remember, at one time, a quarter of an ounce silver was worth 25 cents, 1964. The silver quarter is worth a quarter, okay? And look at what it is now. I mean, again, you're 100% right. There's a hell of a chance for a pretty big move in silver, and I think there's a big move in coming in platinum as well, if you've watched the action recently.
Todd Bubba Horowitz supports Donald Trump for bringing a business-minded approach to governance. Still, he remains deeply critical of the federal government's ongoing deficit spending and lack of fiscal responsibility. Horowitz warns that if current spending patterns persist, the government may eventually struggle to fund essential programs such as Social Security, especially as interest payments on the ballooning national debt consume an increasing portion of the federal budget. Federal interest payments already stood at 3% of GDP last year, according to data from the Federal Reserve Bank of St. Louis. If this trajectory persists, projections from the Peter G. Peterson Foundation suggest that the figure could rise to 4.1% by 2035. The Committee for a Responsible Federal Budget estimates that by then, annual interest payments could reach $1.8 trillion, placing significant strain on fiscal policy and potentially crowding out other public spending. Horowitz argues that reckless spending continues because politicians avoid making the difficult decisions necessary to reform key areas, including Social Security, immigration, and foreign aid. He highlights that the Social Security system is outdated, designed initially when most people didn't live long enough to collect benefits. Today, longer life expectancies and a shrinking workforce are placing unprecedented stress on the system, yet reforms are continually delayed. As interest costs rise and demographic pressures intensify, the consequences of avoiding fiscal reality may soon become unavoidable. Let's get back to the interview.
Well, I love Donald Trump. I've been a fan of Donald Trump the entire time because I think that he's trying to run the states like a business, which I believe is what we should do. Now, again, the deficits, not a big fan of building on deficits, but there's been so much debt created. And the problem is when you have a central banking system, or in our case, a Federal Reserve, or worldwide, a central banking system, they have the ability to print money at will. And of course, that's why inflation is so high. And those are why we have the problems we have, because what happens here is the central banking system, or the Federal Reserve System, did not allow the free markets to trade and establish what true interest rate should be. They start goofing around them and try to time the market. Now, you and I both know as traders, you cannot time any market. So they don't let the free markets trade them, and they just continue to create more money. I mean, if you and I lived like the United States government, we'd be in bankruptcy court or jail for the amount of debt that they created. So I don't like it. I think that we have to do something about Congress and the entire government structure and get back onto a balanced budget and reduce this deficit. But nobody seems to care. They continue to kick the can down the road. I mean, there's so many issues that you could easily cut. Even Doge showed you that there was a lot of areas where money could be saved and we could actually work on this. But again, you continue to kick the can down the road. And with the retirement age at 65 still, that's kind of ridiculous when you think about it. So I think the U.S. dollar still will be the safe haven. I think that Trump is trying to ensure that. But at the end of the day, they got to stop spending. They've got to stop the whole political gamut in the states. You know, there's too many criminals in our government, whether they be a Democrat or a Republican. It doesn't matter. They're both equally at fault and equally guilty of making too many bad deals in this country and spending too much money in other places other than here. We still give away too much money. I mean, the illegal immigration problem in this country is billions and billions of dollars that has to be cut. I mean, they have to be deported. They have to be taken out because they take advantage of the system and there's too much money being taken out. The Social Security system, when it was put in play by Roosevelt, it was the average living age was 62, retirement age was 65. So the Ponzi scheme that they ran on Social Security was based on that most people would be dead. They'd never collect that money. Well, now the average living age is 78 and we're still paying off at 65. There's not enough employees. There's not enough people in the workforce to satisfy that. So the true retirement age now should be 80 if you want to stay on the formula, because now you're paying out money that you don't have. And of course, the government misspends the Social Security money that I pay. I mean, I paid the maximum every year that I've been employed. Okay. And I'm never going to get that money back. And of course, Trump came up with a great idea a couple of weeks ago. And he said, well, we're going to put $1,000 in a series of people's accounts, but it's untouchable until you can retire. And it's going to be managed by a firm where the government can't touch it either. Now, that would be a great plan. Okay. But again, you've got too many ways and too many places that we're giving money to. Look at all the money we've given to Ukraine. Okay. Look at all the money we've given and blown through China and through other areas. That's the bigger issue. But again, these politicians are all on graft and are all getting something out of these ridiculously bad deals that they make. And again, it doesn't matter. This is a nonpartisan issue or a bipartisan issue. They don't care. They want the money, because why else would any politician spend $4 million of his own money to get elected to a $200,000 to $100,000 a year job? Listen, the states, there's a lot of job issues here, and partially because they pay too many benefits to people to not to work, partially because you've got, the AI may be a great tool, but it's destroying jobs for people that don't understand computers, that don't understand that kind of work, and can't be employed in it. When we went to the original industrial revolution, everybody could work, and they could work the line, they could work everything, and everybody made a lot of money. They made good money. Now there's no money to be made. So if you're not skilled, okay, then you're not going to make. And the truth of the matter is, my industry, the trading industry, that's a lot harder than it was as well because of what's going on. So you're destroying the opportunity for people to make any real money. Okay. And again, so it's the same thing here. Jobs we're at the worst job situations since 2021. And I think it's going to get a lot worse before it gets a lot better. But this goes back to my whole theory that you have to let the free markets trade and allow competition and allow people to come in versus trying to shut it down. And in 2008, they should have let the banks that were weak go out of business and let new banks come in, not support the banks. That was ridiculous that me, the taxpayer, get to help support a bank because they're supposedly too big to fail. Let them go out of business. There'll be other banks. What you should be guaranteeing is not the banks, but you should be guaranteeing the depositors so they get their money back and then they can take it to a different bank. I mean, the banking sector is too huge to begin with. They've got too much control. And of course, you mentioned printing money. I mean, fractional banking allows them by law to lend out 10 times 10 to 1. Now, again, first of all, more lend out more than 10 to 1, even though it's not legal to do so, but they do. And the other problem is that, the banks borrow from the Federal Reserve. They borrow right now at a rate of, let's say, 3%. Well, we had 2 rate cuts last year, but that rate cut only got passed on to the banks. It didn't get passed on to the consumer. Mortgage rates are higher. When this whole rate cutting started, the 10-year notes were 3.5%. So the 10-year notes are up 100 basis points, and the Fed funds rate is down 100 basis points. Where's the benefit to the consumer? So the banks are printing money by lending out more. They're making money. And the worst case is now they figured out a way to take the money that they borrow from the Federal Reserve, turn that liability into an asset, and then lend out 10 times that. Where's the fair and equal value for everybody else? Doesn't work, right? I mean, that's indeed the problem in printing dollars, which causes massive inflation. And it's interesting, real quick. I always talk about 1985, how much different it was. I actually have proof now. In 1985, the average income was $25,000 a year. The average house was $80,000 a year. So three and a half times. Now, the average income is $70,000 a year. The average house is $500,000. So it's 7 times. So where's the difference? The difference is letting the banks steal the money, standing up for the banks. But of course, we all know who the Federal Reserve was started by: Paul Warburg, the Rothschild family, the Rockefellers, and J.P. Morgan. You think they're going to cut a break? They're going to steal as much money as they can.
Silver's recent surge is less a surprise and more a reflection of long-ignored fundamentals finally catching up with market sentiment. Its dual nature as both a monetary metal and a key industrial input places it at the center of 2 powerful demand engines. While macro headlines obsess over inflation and interest rates, silver's story is unfolding quietly through solar panels, manufacturing lines, and a tightening gold-silver ratio. As it pushes toward historic resistance levels, speculation is giving way to structural tailwinds, marking what could be a breakout year that will be remembered well beyond 2025. Is silver on the brink of reclaiming its legacy as not just gold's shadow, but a dominant force in its own right within the global financial system? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.